So it's widely expected that interest rates will remain unchanged when the Reserve Bank's Monetary Policy Committee finishes meeting tomorrow. The bank surprised the market in January, lifting interest rates off 40-year lows and raising them for the first time since 2008. It has since said it will probably raise interest rates more slowly than it did in the last hiking cycle 6 years ago. So most experts are now expecting that rates will go up sometime this year or next year, but the timing is unclear. The bank is worried about the weaker rand fueling inflation. Interest rates dampen spending as consumers have less in their pockets. But with consumer spending already under pressure and, according to some, keeping the economy going, economists have been asking if South Africa can indeed afford another rate hike. Well, to discuss, we're now joined by Becker from ETM Analytics. Great to have you with us, Chris. Do you agree with almost everyone? No rate hike tomorrow?
Well, not quite. I mean, amongst most of the economists, people expect an unchanged decision tomorrow following the 50 basis points hike in January. But when you look at what the market's pricing, looking at interest rates markets and bond markets, the market's expecting and pricing around a 30 to 40% chance of an interest rate hike tomorrow.
And,
so it's not that nobody's expecting.
Banks go up today with some hope of an interest rate hike.
Yeah, I mean, also equity analysts and investors, I think, may be expecting that higher interest rates might lead to better interest rate earnings for the banks. But we know this economy is in quite a weak state. People are carrying a lot of debt and credit, and if interest rates go up, the cost to service that debt is going to go up as well, and that might through time actually pressure the banks. So in the short term, yeah, they could go up. Over the longer term, it's not necessarily a bullish story.
Okay, so you're saying we may be in for a surprise. Jill Marcus did seem to dampen those hopes a little bit, speaking a few weeks ago.
She has. Look, the Reserve Bank is still quite dovish. This economy is in a weak state at this stage. The surprise interest rate hike in January came because there was basically an emerging market crisis where the Turkish lira was crashing. They hiked interest rates by 3 percentage points. The Brazilians were hiking interest rates. And if the Reserve Bank didn't hike rates back then, they would have exposed this rand to even more significant weakness. So they really had to respond. But following that interest rate hike, the rand is essentially stabilized. And I think, Jill Marcus has been quite clear that we shouldn't expect too much going forward. But just to say also, at ETM, we've been arguing for the better part of 3 years now that the Reserve Bank should be hiking interest rates slowly and steadily while everybody else is loosening policy. And while the South African economy was still reasonably robust, and while there was still some reasonably, not strong growth, but there was growth. At this point, as we know, this economy's tilted its nose downwards, and there's many negative stories on the macroeconomic front. And we wouldn't be surprised to see GDP growth slow significantly through this year. We could be on the cusp of a recession. Our business cycle index at ETM has been showing this. So essentially, the Reserve Bank's in a bit of a bind right now. If it hikes interest rates, it weakens this economy even further. If it doesn't hike, this rand's going to go even weaker. And so that's the catch-22 that they're in right now.
You're picking up on what a lot of people have been saying, that this economy is weak right now. Consumers are on the brink. Can they handle, and can the economy handle another interest rate hike? It sounds maybe not, because you're talking about another recession.
There's two sides to the story. We've got to remember there's debtors and there's creditors in this economy. There's low-income earners who aren't able to access credit, but they are heavily impacted by things like staple food inflation. So at ETM, we track a consumer price index basket, our own one at 4 stores in the 4As area. And what that shows is very strong inflation. So in fact, this week, we've gotten our first full year's worth of reading. And our CPI has gone up 13%. And the bulk of that is being driven by staple foodstuffs, like maize is up 25% in the last year. Low-income earners are being hit hard. If they don't start hiking interest rates, that type of inflation is going to continue to go up, and it's going to cause more social unrest and more demands for even higher wages. If they do hike, they could help the rand strengthen somewhat. It's going to pressure people who are in debt, who have credit and are interest rate sensitive. But it then could, on the other side, help other people. So that's kind of the dynamic and this dualistic type of economy that we're seeing.
Consumers will feel pain.
Yeah.
Let's look at a cartoon that you sent us. It's about the elephant in the room, and it is very strange. Here we have it up behind us. So the elephant called Bernanke, name change
so
needed.
Ben Bernanke, the chairman of the US Central Bank, he's obviously left office and Janet Yellen's taken over from him. But we had, who I regard as the best cartoonist in South Africa, Jeremy Nell, He basically did this drawing for us at ETM. And it's Ben Bernanke sitting around the boardroom at the central bank, at the Reserve Bank in South Africa. Essentially what Jill Marcus and the South African Reserve Bank has done is they've hitched their caboose to what the Fed's doing. They've been copying the policy of the Fed in the last 4 years. And because we were lowering interest rates as the Fed was printing a lot of money, as they now start to slow printing of money, we are having to hike interest rates. And that's really the type of environment we're sitting in. So because we've copied what the Fed's done in the last 4 years, we're being forced to copy them in tapering QE at this point.
But it's also emerging markets starting to raise their interest rates. How much are we following and how much are we making decisions for our own economy?
We're lagging. We're not making decisions as much for our own economy. I think the Reserve Bank's intentions are to make decisions that would benefit this economy, but the data shows that the weak rand and low interest rates actually aren't. If we look at India as an example, the central bank governor came in there last year and he started hiking interest rates. The rupee's recovered, the stock markets hit record highs yesterday, the economy has attracted foreign inflows once again, and things are starting to stabilize. So their current account deficit's being financed, their budget deficit's being financed, the rupee stabilizing. And they're leading the cycle. We're not really following them. We're sort of following the laggards, the likes of Turkey and the Brazilians, who are seeing a lot of unrest and credit downgrades in Brazil yesterday, and so forth. So I think the South African Reserve Bank is essentially behind the curve here. We still need to do a lot more in tightening monetary policy to purge the imbalances in this economy. And I don't think it's going to happen tomorrow. It might need to play out in time.
Well, what does it mean for somebody maybe watching us who has a bond and wants to know how much are interest rates going to go up in the next few months, over the next year and a half?
At ETM, we've been holding the view that this is not going to be a long-term sustained interest rate hike cycle. We've essentially been talking about this camel hump rate hike cycle, where we might see a total of 150 basis points worth of rate hikes to the short-term repo rate, but then that the negative consequences on the broader macroeconomy is actually so negative that the Reserve Bank has to start responding by cutting interest rates once again. So in 18 to 24 months from now, we could have gone up to 7% on short-term rates, potentially on the upside, but that the Reserve Bank would have even started cutting to come back down to where we are today. So it could get quite volatile.
Very volatile situation. Thank you. Very interesting analysis. That was Chris Becker from ETM.